All right. Good afternoon, everyone. Thank you so much for joining us today for Exploring Franchise Ownership, our virtual lunch and learn. We're so glad to have you here and taking time out of your day to invest in yourself, your business knowledge, and potentially your next big opportunity. For those who I haven't had a chance to meet yet, my name is Kylie Adams Weiss, and I serve as the Senior Vice President of the Carbon Chamber and Economic Development Corporation, a proud partner of the Greater Lehigh Valley Chamber of Commerce. At the CCEDC, our mission is to support and strengthen the business community here in Carbon County, and programs like today's Lunch and Learn are designed to do exactly that. Whether you're an entrepreneur or exploring a career shift or simply curious about business and franchise ownership, today's conversation is meant to provide valuable insight into what franchising can offer. Before we get started, I'd like to take a moment to thank our sponsors for making programs like this possible. You can hit the next slide, please.
Yep.
Our series presenting sponsor, the Small Business Development Center at Wilkes University, St. Luke's Carbon Campus, Carbon PA Career Link, Lehigh Valley Hospital Carbon, and Pocono County's Workforce Development Area, and our series gold sponsors, Mauchunk Trust and Blue Mountain Resort. Your support allows us to continue providing educational opportunities, resources, and connections that benefit our entire business community. So thank you for your continued partnership and investment in Carbon County. Today's session will explore the fundamentals of franchise ownership, from understanding common myths to exploring different ownership models and how franchising compares to starting or buying a business from scratch. It's a great opportunity to ask questions, learn from our expert, and really start thinking about whether this path would be a right fit for you. We encourage you to treat this as an interactive experience. If you have questions, please drop them in the Q&A section of the webinar platform, and our speaker will address them at the conclusion of today's program. It is my pleasure now to introduce today's speaker, Sean Haggerty of FranNet. With a career spanning franchise ownership, executive leadership, and financial expertise, Sean brings a well-rounded and practical perspective to franchise consulting. As a certified franchise consultant with FranNet and a CPA CGMA, he has helped entrepreneurs navigate the path to successful ownership, including franchises that have grown into top-performing multi-unit operators. Sean is passionate about helping individuals find business opportunities that truly align with their goals and their lifestyle. We are very excited to learn from his expertise and perspective today. So with that, I will turn today's session over to Sean to lead us. Thank you so much for being here, Sean.
Yeah, great. Thanks, Kylie. I appreciate that intro, and welcome everyone. Happy to be here this morning and early this afternoon with all of you to, really kind of give you a high-level overview of the franchise business. I think this will, give you a lot of information to help you with that process. Let me start by giving you a little bit of background on who FranNet is. FranNet is almost 40 years old. We are the oldest franchise consulting firm in the United States. And, franchise consulting, my job, I always say, is to get my client to a yes or no on franchise business ownership. And the reality is probably about 95% of the people I speak to will not go into franchise business ownership. And that's okay. And how we go about doing this with the 5% of people that do go into franchise business ownership, we have a very strategic and methodical approach, which we're going to talk to today, which helps people realize their dream, and we help match them with the right business. That's really, kind of our claim to fame, is matching you with that right business. Okay, we're kind of like the executive search of the franchise world. We have national partnerships with SCORE and SBDC. I think SBDC is part of this today, and I'm very happy for that. And our services come at no cost and no obligation to you. Now, that doesn't mean we're a nonprofit. FranNet is a for-profit business, but we get our fee. If we were to place one of you, if you become a client of ours and we were to place you in a franchise, we would get our fee from that franchise company. Okay. I think Kylie did a pretty good job of talking about who I am. I was awarded a franchise because FranEd is a franchise. So we do walk the talk. I was awarded a franchise opportunity with FranEd almost 2 years ago now. And I'm really enjoying it. I've had a lot of experience with FriendNet. I first met them in 1998. I went through that process with one of their consultants, who, by the way, is now the chairman of the board of FriendNet International. His name is Jack Armstrong. He helped me and a buddy in 1998 get into a franchise. We kept it for over 5 years and eventually sold it and did very, very well. So I'm back in the franchise business. Between 1998 and today, I had a lot of different corporate business opportunities. I worked with Jackson U Attack Service, which is a large franchisor. So I really learned the other side of the franchise business. I also owned, and with two other partners, and sold to Broadridge, which is a massive fintech company, a software development company. But now I'm really here to really help people get into franchise business ownership and share with them the experiences that I've had with it. All right. So what are we going to do today? What are we going to learn about today? A couple things. Number one is why business ownership. I think this is the foundational, it's a fundamental question, but it's really the foundation of getting into franchising. We're talking about what is a franchise. Want to make sure you understand what a franchise really is. Then number three, we'll have some fun learning about the franchise landscape. We're going to talk about some of the myths and misconceptions about franchising that are out there. And many of you probably know them, and we're going to tackle those. So we'll have a little bit of fun. Number four, franchising is regulated. And I use that word regulate. Sometimes people look at regulation as a bad thing, but in franchising, if you're really looking to get into franchising and become a franchisee, the regulations are very, very helpful. And we'll talk a little bit about that. Then we'll talk about the franchise search and due diligence. There's multiple ways you can do your search and due diligence. We'll talk about our program and other ways that you can do that. And then we'll tackle the Q&A. So let's start with that all-important question: why business ownership? Why do people want to become a business owner? And a lot of it has to do with career satisfaction or lack of satisfaction for that matter. The old mantra, my father told me, Sean, you're going to college. You're going to go to college, you're going to study hard, you're going to get good grades, you're going to leave, get into corporate America, you're going to climb that corporate ladder, and you're going to be successful, right? And success means a lot of different things to a lot of people, but that's what it meant to my father, my parents, and that's kind of the course I took. But in today's day and age, things aren't quite as easy as that. Many of you probably know that, climbing that corporate ladder could be elusive today, much more than it was 30 years ago or 20 years ago, for sure. What changes? There could be changes in management. Artificial intelligence is changing things. We all are aware of that right now. Acquisitions, right, can change things, right? And all of a sudden, this path to this success that my father laid out for me and my mother starts to become more difficult and challenging. And that's where people turn to business ownership or franchise business ownership. It's a new pathway. It's a new avenue to get to your definition of success. I work with clients, and everyone has a different definition of success, right? I talked to a client the other day, Jim, and he was telling me, Sean, what's important to me right now is flexibility. I've worked 50 to 60 to 70 hours a week for 25 years. I want some flexibility. I want work-life balance with my family. That's a good reason to explore, business ownership. That's a good why, right? Other people want control. They want control over their hours. They want control over the money they can make. That's another reason for potentially looking at business ownership. So whatever your definition of success or your why, that's where we like to start and make sure we understand. And then we work backwards and work with our clients to match them with the right franchise. All right. I think I said I started the meeting out saying 95% of the people I talk to never go into, franchising or business ownership for that matter. And why does that come up? Number one is risk. A job, people have that perception jobs are safer. And there's a lot of truth to that. In the early part of your career, in most people's career, it is true. But once you get up into middle level management, as you're climbing that corporate ladder, things get a little bit more dicey, as I mentioned before, right? So, the average for a middle level manager, the average in a job or a certain position is around 3 to 5 years. Okay. So when you get up into middle level management, things change a lot. Now, with business ownership, the first couple years can be dicey and risky as well, right? But once you get into that 3 to 5 years, things start to level off quite a bit. And all of a sudden, running that business becomes easier and less risky. So, having a traditional job is definitely safer in the short term or when you're starting a career. But as you progress into your career, and certainly more, over 5 years or so, it gets a little bit more risky. The flip side of that is business ownership is risky up front, but as you get into that year 3 to 5, it gets less risky. Okay. So there's that kind of a trade-off between the two. The other thing I hear from people all the time is money. It costs too much money. You got to be a multimillionaire and millions of dollars to get into franchising. Well, the average initial investment in a franchise today is not millions of dollars. It's pricey, but it's not millions of dollars. It's about $300,000, right? And there's some franchises that you need to have $2 million and multi-million dollars to get into. And there's also franchises that you can get into under $100,000, right? Knowledge, okay? Knowledge is what we bring to the table to help people, and what we're going to be talking about today, how we help you understand the world of franchising. Skills, people don't join because owner is going to be. That's very, very important, because you're not going to be doing the day-to-day, right? You want to work on the business, not in the business. So we focus on, what does the owner need to do? What type of leadership skills do you have? Organizational skills, right? Maybe sales and marketing skills. So we focus on what the owner does. All right. So there's basically 3 ways to get into business, and everyone on this call knows this. You can start a business from scratch, right? You can buy a franchise, or you can buy an existing independent business, or you could buy a franchise business that's already up and running. So let's dive a little bit further into each of these and talk a little bit about the pros and cons, because everything in life has a pros and cons. And the same thing with getting into business ownership. There's pros and cons to each of these different combinations of getting into business ownership. So to start your own business from scratch, what are the pros to that? Well, the initial investment is typically lower than other, getting into, either buying a business or getting into a franchise. That initial investment, okay? Availability, the sky's the limit, right? The only thing that you have to derail getting is really your imagination, right? You can get into any business, any industry you want. So that's a pro. But there is 2 kind of cons to starting your own business from scratch. Number one, on average, it takes about 3 to 5 years to get to break even. So over the course of that 3 to 5 years, you're actually spending a lot more money than that initial investment up front, right? And you've got startup capital, you've got opportunity costs, you've got living expenses, ramp up costs to get you to break even. When they all pile up, excuse me, all of a sudden, starting your own business from scratch gets quite expensive. The other thing with starting your own business from scratch, it's high risk, high reward, right? There's a tremendous amount of risk going out there with the unknown and starting from scratch, typically. However, with that said, if you hit it right, it could be the most lucrative and probably the most rewarding experience as well. Okay. So that's starting your own business from scratch. Let's move over to buying an existing business. A lot of my clients come to me and that's what they want. Sean, I want a business that's already up and running. They've got employees, they've got clients, they've got goodwill built in, and they've got maybe even have profitability, right? They want a business that has throwing off cash flow. Well, I hear that a lot. And, right, wrong, or indifferent, that's kind of what I always hear from our clients. Now, one of the things about the downside to buying existing business, there's two of them that I'm going to mention. I'm not going to go through each one of these, but there's two. Number one, and probably the most important, is limited availability. There's not a business, a profitable business, a strong business on every corner in every town in America. They're very, very limited. I did a search the other day for a client looking at resale businesses within the franchise world in the tri-state area. I found 10, and most of those weren't really a business that I would even show them. They were struggling and not doing well. And in franchise resales, the reality is 95%, 95% of the good franchise resales end up getting gobbled up by other franchisees in the system. So limitations, limited availability is a big downside to buying your own business. The other thing is valuation, right? I mean, when you're looking to value an existing business, it trades off a multiple of about 3 to 4 times the owner's discretionary income. Owner's discretionary income is the net income of the business, adding back the salary that the owners are taking out, and then adding back these discretionary or sometimes even personal expenses. So you really got to peel that onion back and really find out what is the true profitability. And then to understand what type of multiple you want to pay, and then compare that to the price that the seller wants for the business. And a lot of times it can get murky, and a lot of business deals fall apart. All right. So let's talk about, so that's the good and the bad about acquiring an existing business. Let's talk a little bit about franchising. Again, there's advantages to disadvantages of franchising as well. I'm going to talk about 4 key advantages to franchising, and there'll probably be a theme that you hear throughout this presentation: name recognition and licensed trademark. Now, I don't mean that the franchise has to be a household name or a kitchen table name that everyone identifies with, but it has to be a strong brand, strong business within the industry that it represents. The other thing that's really important is franchises, or an advantage of franchising, is they have very, very strong digital marketing today. And brand awareness, not only through their website, but also their digital marketing, social media marketing, that you as a franchisee get to leverage and not have to build from scratch. So there's a lot of great equity built up in their websites and their digital marketing. Proven business system, all right? That's probably the most important thing that you would acquire with a franchise. The system has been proven 100 times, 500 times, maybe even 1,000 times, right? And these systems, they have operating manual in place and an operating system in place. They have a sales system in place and a marketing system in place. And you get to leverage off all of the proven systems that have been, again, proven 100, 500, or 1,000 times. So that proven business system is very, very important in a franchise, right? The other thing is good franchisors want you to look at their system, use that system, number one. Number two is execute on that system. And if you get off track a little bit, they want to make sure you're coachable to get back on track, right? So they want you to use the system, execute on that system, and be coachable if you get off the system. All right. So they believe in that system. It works. Number 3, training and support. This is another big advantage to getting into franchising. There's initial training. I've seen 1 week to almost 9 weeks. Some of it is online, some of it is in person, but there's a tremendous amount of corporate training. There's monthly training that goes with getting into franchise. There's quarterly training, depending on the franchisor. There's national meetings. I'm going to Franet's national meeting in Boston at the end of April, right? So there's constant communication and training going on, not only in the beginning when you become a franchisee, but throughout your lifetime with the franchise. The other thing that I like the most from a training perspective is within Franet, I have 100 other consultants that I could leverage. 2 years ago, when I got into this, I had 1 million questions. We have a portal. I put out a question, or I pick up the phone and talk to someone, one of 100, I'm getting answers really quick. I don't have to spin my wheels and figure it out by myself. So the other franchisees are a great support system. And then last but not least on the advantages is the franchise disclosure document that I mentioned. The franchise disclosure document, again, franchising is regulated. Every year, franchisors have to put out a franchise disclosure document, which is a wealth of information on the business. We'll talk a little bit more about that later. Well, franchising doesn't come without disadvantages. Excuse me. There are several disadvantages to franchising. I'll cover a couple right here with you. Fewer industry options. Franchising has about 90 industry options, but again, it's not like starting from scratch. There certainly could be an industry that's not represented in franchising. That could be a problem for someone. The other thing is structured operating system with restrictions. If you're someone who doesn't like a structured system, franchising is not going to be for you. And some of the restrictions that are out there are territory restrictions or geographical restrictions, right? In terms of where you can operate, right? Because franchising is about scale and building, multiple units out there across the country and across the globe. So there's territory restrictions. There's also restrictions on the products and services that you can sell through the franchise, right? They have their products and services, and you can't just bring other products and services into the franchise and sell them as well. The last thing I'll mention is ongoing royalty payments. A lot of people, this I think is a misconception in a lot of ways, because I feel with Franet, I get value every day out of my royalty. But some people think it's a disadvantage. But again, all of the training, all of that proven business system that you get, requires you to pay a royalty. And a royalty is a percentage of the gross revenues that the franchisee brings into the system. All right. So those are some of the disadvantages. Let's move on. Advantages of franchise ownership. We say it all the time. Number one, you're in business for yourself, but not by yourself. I can't overemphasize that. We talked about it on the previous slide. You're not alone, right? I sometimes think, number two, of franchising as a corporate halfway house. Some days I feel like I'm in corporate America, and other days I feel like I'm an entrepreneur out there with a lot of flexibility. So it's a good combination of that support and being able to be your own business owner. It saves time in launching a business. Getting up and running. Because of that proven business system, you can get up and running and moving towards, break even quicker than a startup. Like I said, 3 to 5 years to get to break even. In franchising, on average, it's about 12 months. Okay, now some are 18 months, some are 24 months, some are 6 to 9 months, but on average, about 12 months to get launched and get into break even. And overall, it reduces your risk compared to traditional business ownership that we talked about. For example, starting a business from scratch, after 5 years, there's about 50% of businesses survive. Okay. When you buy an existing business, it's about 60 to 80% survive after 5 years of buying that business. In franchising, it's 85%. Okay. And quite honestly, don't have the current numbers, but in Franet, it's over 85% of our clients after 5 years are still in business. So it is a little bit of a reduced risk towards, compared to these other options. All right. Let's see where we are. So let's talk about what is a franchise. I think that's important to understand the fundamentals of what is a franchise. And at the end of the day, a franchise is a license where the franchise headquarters or the franchisor licenses to the franchise operator or the franchisee through a franchise agreement that both parties sign, the name and trademarks that we spoke a little bit about, the products and services, and that all important business system. Now, in return, right? In return for that, the franchisee or franchise operator has to enter into an agreement. On average, the franchise agreements on average are about 10 years, right? They have to pay an initial startup fee to join the system and get that initial training and get access to that proven system. On average, the initial franchise fee is about $50,000. Okay. And they have to pay, as I mentioned before, ongoing royalties. And on average, it's about 6 to 8% of the gross revenue or gross sales that the franchisee brings in. All right. So let me just repeat that one more time, what a franchise is. Franchise is a license arrangement where the franchise headquarters or the franchisor licenses to the franchise operator or franchisee through a franchise agreement that both parties sign. They license the name and trademark, the products and services, and that all-important business system. And in exchange for that, they have to pay initial franchise fee and ongoing royalties over the life of that 10-year agreement. All right. Let's go down to the next one here. So, excuse me, a lot of people think franchising or franchises is an industry, and it's not. It's really a distribution method. It's a way to scale a business. So, you have some of the franchises most franchises start out with one unit, one location, right? So they want to get into franchising so they can replicate that with the business systems that they've documented, not only replicate it within a state or regionally, replicate it across the country, and replicate it globally, right? So that's important. I think a good example that comes to my mind, and my daughter loves this, franchises, Crumble Cookies. Back in 2017, 2018, Crumble Cookies, they had a handful of locations. Today, they have over 1,000. So franchising is a mechanism to help a franchisor to really scale their business pretty efficiently. All right. The franchise landscape. Okay, this is where I talk to you. When I talk to you, and I mentioned earlier, we'll kind of get into a little bit more of some of the myths and misconceptions about franchising, which I think is really important for everyone to understand. Myth number one, franchising is fast food and retail. So, right, it's hamburgers, it's French fries, right? It's hot dogs, it's waffle fries, it's yogurt, it's things of that nature. But the reality is between 3,000 to 3,500, there's 3,000 to 3,500 different franchise companies in existence today. Why there's not an exact number, excuse me, I really don't know. But that's somewhere between 3,000 and 3,500. So there's a lot. Franchising, again, I mentioned this before, covers 90 industries. So it's pretty vast. There's over 800,000 operational units or locations. So think about that as a physical locations that you see. And it's almost 3% of GDP. So franchising is huge. It's big. Most people don't realize how big it is. If you take a look at the pie chart here to the right, and this is pretty much franchising defined by the number of locations or number of units. There's a lot of ways you can cut up and define franchising. I like locations because they're physical and you can see them. And as you can see, if you take a look at full service restaurants and QSRs, which are quick service restaurants, right? That fast food, it's about 28%. So it is. It's another 22%. So when you look at retail and food, it's 50%. So it is significant. Now, we don't concentrate our efforts too much in the food area, but the areas that we do focus with clients on is personal services, business services, and commercial and residential service. That's our area of expertise. All right. Personal services is 16%. That has been the fastest growing over the last several years, fastest growing of everything in franchising. Okay. Personal services can be pet supplies, they can be beauty, wellness, fitness brands, senior care fits into that area of the pie chart. They're all considered personal services. Business services, another big area that's interesting. That's business to business. So we have quite a few business franchises in our system that really help small to mid-sized businesses, businesses that have 5 to call it 50 to 100 employees. And they need to outsource services as well. I'll give you an example. We have a franchise, CMIT, right? It's the chief technology officer of a small or mid-sized business. They do everything from buying computer equipment, helping them with their apps, all types of security issues, AI. That's what this company does, and it's business to business services. And business to business services, it's only 12% here based on locations, but on revenue, it's much larger. So it's a very good area that we focus our clients on. The last one that we focus our clients on is commercial and residential. That's another big area, residential. I can't think, or you probably can't think of a residential service that we don't cover. Whether it's pool services, pest control, power washing, window cleaning, painting, we have a residential service for everybody. Rounding out this pie chart is real estate. Weichert Realty is a franchise, and then lodging at 4%. And a lot of people don't realize, but Marriott is a franchise. Okay, so that kind of rounds out. We are not in the real estate and the lodging. Again, our clients that we work with, our clients are and focus them on personal services, business services, and commercial and residential services. All right, this is kind of what I've already talked about. Is if you take a look, the at the top line, that's those personal services that are leading the growth rate, and it's up above 7% there. And then when you go down to the next three lines, that's QSRs, lodging, I believe, and commercial and residential services. They're all above 5%. So it gives you an idea in, not exactly per industry, but in the big captions that I showed you, the growth rate of some of these areas. All right. Myth number two, franchises are expensive. And we touched on this a little bit. And I mentioned on average, right? The average franchise initial investment is about $300,000. Now, as you see these percentages in the one column here, this is based on franchise brands. So 7% of the franchise brands in the 3,000 to 3,500 are under $50,000. Okay, so that's kind of what that really represents here. As you can see, again, you don't have to be a multi-millionaire to really get into this type of area, right? And again, most of the clients we work are the 7 under 50,000, 50 to 100, 100 to 250, and 250 to 500,000 is where that's really our focus with clients. Now, there's 4 variables that make up the average initial investment. And I want to talk about that at $300,000. The first one is venue. Some franchises like mine, I could work from home, right? So it's pretty cheap. I work in my home. Some franchises need a warehouse or industrial space. They may need an office. They may even need type A retail. There's a vast range, right, of depending on the franchise, and the dollars that go into this are vast. They vary significantly across all of those that I just mentioned. The other variable that goes into this initial investment range is, what type of employee do you have, right? Staffing needs, right? Are you looking at a franchise like CertaPro Painters where they outsource, right, all of their work to contractors? Are you looking at a franchise that, they will be employees of yours, but they may be hourly employees of yours? Or they may need in one of our physical fitness franchise, you definitely have to hire a physical therapist. That comes at a cost of $100,000 to $125,000 minimal. So that, again, you can see the vast range of dollars that go into this depending on the franchise that you choose. The next one is a franchise more sales or marketing driven, right? Sales-driven franchises, they're not expensive dollar-wise, but they're expensive labor-wise, right? You have to go out, you have to sell, you have to network in order to build business. Marketing-generated franchises, you have to spend money to acquire clients, right? So you need to understand that cost of acquisition through marketing means to acquire those customers, to get them up, get them running, right? Get them into your system before they start making and generating revenue for you. And many of these marketing companies, you're going to have a marketing budget ongoing. So that's the third. The last one that goes into, what the size of the initial investment is inventory and equipment needs. We don't have a lot of inventory businesses in our portfolio of companies. Most of our businesses are service related, but many of them have equipment needs. For example, we have tree service businesses. It takes $500,000 of equipment minimum to get into that business, right? You need cherry pickers, stump grinders, all types of saws, trucks, and it could take $500,000 of equipment needs to get into that business. Okay, so as you can see, depending on the franchise that you get into, depending on the brand, the initial investment can range vastly by these 4 variables that I discussed. All right, let's talk a little bit about financing. There's multiple ways that you can finance your franchise if you decide to go down that path. One is you could use your own capital, right? Most of our clients don't use their own capital. They use a portion of their own capital, but they leverage debt financing of some sort. So let's talk about a few areas of financing that you can utilize. Number one, you could use a securities-based line of credit. It's not a loan, it's a drawdown. So my clients like that. The rates are pretty competitive, and you're using your portfolio. If you have a stock or a bond portfolio, you can leverage that as collateral and take a draw or a line of credit against that. HELOCs, home equity lines of credit. We've all heard of those. We've all used those. Many of us have probably used those. That's another avenue to get into. Again, it's not a loan, it's a line of credit, and it's competitive rates as well. Another one, and many people have heard of this, is the Small Business Association Loan Program. This is kind of, think of it about as like a mortgage. You're going to have to put down 20, 25%, and they'll put down the remaining 75 to 80% of the loan, right? There's on top of that, they do require something called post-closing liquidity, and that's usually 15 to 20% of the franchise cost. And that's set aside just in case there's some bumps in the road. The ramp up takes a little bit longer. They work with franchising all the time, SBA loans, so they know things happen. So they want another 15 to 25% set aside for post-closing liquidity. Another avenue you can take is leveraging or using your retirement funds, an IRA or a 401k. It's called the ROBS program, Rollover Business Startup, and it's a pretty cool program. Today, many of you have IRAs or 401k plans. They're invested in stocks, bonds, mutual funds, ETFs, you name it. You can take all of it or a portion of it, roll it over into a C corporation that you establish for the franchise. It's rolled over into a fund. It buys the securities of your franchise and frees up the cash. It's a direct rollover. It's tax-free, penalty-free, and it's a very effective and efficient way to fund your business. So the last thing I will say about financing is something that SBA loans can't fund for you. You have to be aware of your monthly living expenses, right? That's very, very important that you understand your monthly. They can finance the business costs, but they can't finance your monthly living costs. So you have to make sure that you have funds available, right? As you ramp up and try to get to that break-even point, that you have the funds available and savings available to get through that period. All right. Excuse me. I'm fighting a nasty cold here, so I apologize. Let's look at myth number 3. High returns require a high investment. And it's a myth. Okay. Let me give you an example. So what it's saying is the amount of money you put in, the larger amount of money you put in means you're going to get a large return on your investment. It doesn't exactly work that way. Let me give you an example. Childcare services, childcare pre-care services, franchises, they cost today, that initial investment, and we talked about 300,000 as average, they cost about $2 million, even over $2 million. Goddard's good $2 million today to get into. However, the ROI on that is about $600,000. The EBITDA, I should say, the EBITDA on that is $600,000. The ROI is about 30%. Pretty good. Let's take a look at CertaPro Painters. CertaPro Painters is the largest painting franchise, commercial and residential, in the country. The initial investment there is about $250,000 to $300,000, right around the average, right? However, the EBITDA that throws off on average across all of their franchises is about $550,000. So well over almost 200%. It's way higher than the return on investment for a Goddard childcare. So again, the point here is it's not you put in as much money as you can, that it's going to guarantee you a return. It doesn't really work that way, is the point. Now, I mentioned, so I gave you personal services. I explained our clients come, we put our clients in personal services, business to business services, right? Those types of services. And I want to drive this home a little bit, this point a little bit more, but we typically ask our clients to look in 3 big buckets. Number 1 is growing markets driven by demographics, right? And there's 2 demographics that are really driving business today. And you guessed it, baby boomers, there's 10,000 turning 65 every day, and millennials. baby boomers are driving the senior care services. And that's kind of an umbrella term. It's not just in-house care, whether that's nursing care or companion care. It could be placement services, right? To place, a family with the right daycare or the right senior care type of service. It could be that. It could be equipment companies that come into the house and make it more user friendly or senior friendly, right? Whether that's chairlifts, ramps, all types of handrails and things of that nature in the bathrooms and through the house, so seniors can navigate in their home much more freely. It could mean estate sale companies are part of senior care. So it's a huge umbrella under senior care. In terms of millennials, they became the largest homeowner in the United States during the pandemic, right? And to their credit, they're trying to find balance. We talked about balance. They're trying to find balance in their life. Many of them are young. They're working in corporate America. They outsource a lot of their housing needs, right? Those services are around, as I mentioned before, cleaning the pool, pest control, power washing, painting, window cleaning, in-house cleaning, all of that is outsourced and really has driven those businesses quite a bit over the last several years. The other area is many millennials now are dual earners, and guess what? They need childcare. All right. And they need daycare centers, preschool learning. That's another big area that's been growing at a nice clip. The other bucket that we focus our clients on is essential services. I won't say these are recession proof because I don't think anything is recession proof, but they certainly can help with the highs and lows that an economy goes through. The first one I'll talk about is commercial cleaning. I like commercial cleaning quite a bit. It's very sticky, very annuity driven. And I'm not talking about the commercial cleaning in big high-rise buildings. I'm talking about commercial cleaning in doctor's office, dentist's office, automotive dealerships, churches, synagogues, excuse me, schools, industrial buildings, warehouses. Those types of commercial cleaning opportunities are out there and growing every day. The other one I'll mention is restoration, cleaning and restoration business. They have been booming over the last several years as well. These are businesses that are called in if there's an accident or a natural disaster. It could be a fire, could be a flood, right? It could be mold and mildew in the house, right? They're growing at a very nice clip. The other thing is most of those services are paid by insurance. It's another thing to note. And then the last bucket, and I mentioned this a little bit, is the business to business services to really support small businesses. Businesses in the 5 to 500 employees. I mentioned CMIT, the IT outsourcing service. A small business absolutely needs IT resources. It's complex, it's changing as we speak, and that is a service that is really, really needed very much. And there's digital marketing services out there. FranNet is a consulting franchise, right? I mentioned that there's a lot of other consulting franchises out there. There's staffing solutions to help small and mid-sized businesses. The one thing I did gloss over here is kind of a hybrid. It's in the healthcare area. It's a hybrid between, senior care and essential services. I mentioned we have a physical therapy brand called Physical, Phyzical, and it crosses over both of these, right? It's definitely essential service. My wife just had surgery on her wrist and hand, kind of carpal tunnel syndrome, and had some surgery. She's going and using physical therapy. I'm not sure there's many surgeries or procedures done now medically that you're not going to some sort of a physical therapist. And it also falls under a little bit of senior care. Definitely the majority of our physical therapy franchises, they are working with seniors. All right. I wanted to chat a little bit, real quickly about franchising, perception or reality, just really at a high level. And some of this I've already touched. I'll go through it quick. You're truly your own boss. You are. To a degree you are, but remember there's a system in place, right? They want you to follow that system. They put guardrails in place, these franchise companies, right? They're trying to protect their brand. They're trying to protect their equity in their brand, right? So you are your own business, but you're working within that system. Okay. Franchising means guaranteed success. I talk to clients every day about this. Oh, and a lot of people get tripped up with this. They go into franchising, think, oh, we got the model. It's going to succeed on its own. Doesn't work that way. It needs your sweat, blood, and tears. Like anything else, any job that you're in needs your sweat, blood, and tears in a lot of ways, right? To be successful. Same thing with franchising. All franchising systems are the same. They're not. A lot of it depends on the maturity of the franchise. We mentioned McDonald's. They put a lot of guardrails around their franchises today, but they have pretty decent returns too. New franchises, they're a little bit more flexible, right? They don't have as many guardrails around their system. So you do have a little bit more flexibility. So no two franchises are created equal. That's important to point out. And we help our clients understand that going in to see how to match that client with the best franchise, right? Franchise creates passive income. People think that, again, it's kind of like, franchising equals guaranteed success, that you could work 10 or 15 hours in a franchise, it's going to throw off passive income. And it's not that clear. It can throw off passive income once you get a team in place, once you get, a group of people that can understand the business and work for you, then it can, but it takes time. Franchisors win when the franchisee wins. Not all the time, for the most part, the great franchise companies, they win when the franchisee wins. But the model, franchisors, right, they get their money off of a percentage, those royalties, right, or franchisees are focused on profit, right? So we've got to make sure when we align a client with a franchise that both the franchisor and the client are aligned, all right, with their ultimate goal. What makes a franchise work? It really comes down to two things: system quality, a good franchisor, and operator quality. We have a good franchisee. Again, their why is correct, right? The 5% that I work with, they're solid franchise. Good, they're going to be good franchisees, right? So you go through some of these strong unit level economics under the system side, system quality. A good franchise is worried about the money a franchisee is making. Okay, they're very concerned about that. They want to increase their profitability. Okay, and their sales and revenue as well. Another thing, responsible territory planning. Some franchises they get a little cockeyed. They get outside of their expertise and they put up too many locations, and that comes back and bites them. So they have to be responsible. The number of territories that they're actually putting out there, and the number of units or locations that they're putting out there, so everyone has ability to be profitable. Real training and ongoing support, that's critical. We talked about that. Alignment with franchisee profitability, I talked about that in the other slide, right? The good franchisors are aligned with the profitability of the franchisee. In terms of the operator, adequate capitalization. We talked a little bit about financing. We want to make sure we're not putting a client into a business that they just don't have the right capital and the right resources. We make sure that that's aligned very, very well. You have to be willing to follow the system. I've mentioned that multiple times. Operational discipline, right? You believe in their model, and you follow that model again, and you'll change, and you're coachable. Local market execution. As a franchisee, you're going to know your market the best, right? And you have to know whether it's a sales type of a franchise you're working with or a marketing franchise you're working with. And you may have to get out there and network and things of that nature, but you should know your market really well. So franchising isn't good or bad. It really comes down to the system and the operator and making sure that they're aligned, right? So the thing you can't forget about is the most important factor is our clients that are getting into franchising. That's very, very important. I'm thinking about a franchise, CertaPro Painter. The largest franchisee in their system does over $18 million of revenue. Extremely successful. The bottom franchisee in the system does about 170,000, and they're operating about the same amount of time. So that's an example of what we've been talking about in the last couple of slides. Is it CertaPro Painters is a bad franchise? No, it really comes down to the operator. Okay. So whoever, they probably got into the wrong franchise, that $170,000 revenue person. They took it for granted. They thought it may run itself, right? They didn't put the right people in place. Who knows? Okay. So what do we look for? A thriving franchisee, they get it, right? And what we mean by they get it, they understand that there's a system that they have to follow, right? As we talked about before. All right. They want it, right? My clients have the right amount of grit, and they're opportunistic, right? So they understand that it's hard work, it's not easy, but there's a great upside if you do it right. You have to be ready for it, right? Are you talking to your family, right? Are you financially prepared? All right. These are all important things that pop up as you're working through this. And you got to understand the ramp up, and that time to get to break even is very important. And will you work it? We talked about this already as well. Are you willing to work hard, right, for it? That's very, very important. Let's talk a little bit about, franchise regulations. Franchise regulations. I explained earlier, franchising is regulated business. We'll go through this, fairly quickly. I don't want to bore you with all the legalities of it, but the Federal Trade Commission is responsible for the franchise regulations. In 1978, they issued the franchise rule, which became the bedrock of franchise law, and the creation of a franchise disclosure document. Now, the franchise disclosure document is a document, it's a wealth of information, as I said before. It lays out 23 critical pieces of information that a franchisee needs to know about franchising, okay? A couple other things about the franchise disclosure document. It has to be updated every year by a franchisor. Every franchise has to have one of these, okay? So it's very important. And it's laid out in the same format, right? So you can compare franchise A to franchise B to franchise C. We're not going to go through all of these, but as you can see, it talks a lot about, the business. What is the business they're in? How did it get started? The business experience of the owners. You want to know about those executives that are running this franchise. They better have experience. It goes into some litigation, bankruptcy, initial fees that we talked about. That's disclosed there. Other fees, right? Franchising, every fee is disclosed in franchising. That initial investment that we spoke about, right? That's part of this. The franchisee's obligations, financing arrangements. Some franchisors do offer financing. The territory that you're going to be granted, the trademarks, trade names, products, and services that you're going to be selling on behalf of the franchise that you're part of. Restrictions, like I said, restrictions on what the franchisee may sell. There's an area on renewal, termination, and transfer disputes. Financial statements of the franchise, or audited financial statements of the franchise, or a list of all of the locations and the franchisees and the name of each franchisee, so you can get in touch with them. Okay, so there's a ton of information and sample contracts of the franchise agreement you're going to sign. Again, we're not going to talk about all of these in detail. I just want to mention 3 of them real briefly, because it's all about money, and that's what everyone that gets into franchise is really concerned about. We've already talked a lot about the initial investment, right? Okay, as you can see, this is item 7, right? And it's laid out in a chart, and it itemizes all the major costs that go into it, and it shows a range, right? Because it depends on where you're operating. The expenses could be more in New Jersey than they are in Pennsylvania, right? So it discloses, right? It itemizes the initial franchise fee, advertising and marketing that you need to have, commercial fees, maintenance, equipment, legal, office equipment, all computer systems that you're going to need. And a lot of people think that these dollars get paid to the franchisor. In reality, they don't. They actually go to a vendor, right? An outside vendor, right? A third-party vendor. Okay, so that's important to understand. All right, let's go on to the next finance thing. Item 19. We call this the earnings claim. It's really titled the financial performance representation. There's a few things to say about this item 19. Number one, this is one item that does not have to be disclosed by a franchisor. All right. They don't have to disclose the performance of their franchisees. I would say 2/3 do disclose it, 1/3 does not. Of the 2/3 that do disclose it, 90% of those 2/3, they're reporting information on revenue, sales, because that's what they bring in to calculate the royalty, right? What we talked about. Profitability is only 10% discuss profitability. And the reason for that is it's hard to get expense data and profitability across a big system and to standardize that, right? So that's important to understand. Now, the document that you're looking at here, and I've mentioned CertaPro painters before, I'm going to pick on them again. This is a very good item 19, earnings claim, financial performance claim. This gives, they lay out it's across the entire franchise system from the top franchise, remember that $18 million franchisee to the lowest 170,000 franchisee is included in this. They show averages. They show the median, the percentage above, the percentage below. They go back 4 years to show the medians and averages, again, for the past 4 years. They also show information on how a new franchisee ramps up from year 1 to year 2 to year 3. So you can see how they progress, new franchisees. All right. So that's really, really important. All right. So that's item 19. But someone may ask, Sean, but I need to understand it. Can I make money? Can I make, profitability? Can I make a living doing this? And this is where item 20 comes in. Excuse me. Item 20 is a list of outlets and franchising information. This lists every franchisee in the system, their address, name, phone number, email address, so you can get in touch with them. When we're working with clients to go through the due diligence, right, to understand if this franchise really works for them, it's matched properly with them, we tell franchisees to go, our potential franchisees, to talk to 8, 10, 12 of these franchisees. They'll help you build a financial plan, build a business model, okay? So that's very, very important. The other thing that item 20 shows is if the franchise is growing by locations, right? So over the last 3 years and by state, it shows whether the franchisee is growing, whether it's how many franchise awards, how many the franchisees are bringing into the system. So that's outlets open, terminations, non-renewals. So they go into all of this. So is this franchise growing by location? Right now, CertaPro is not. They're going through a little bit of restructuring of their own. They're taking back some of the poor performing franchisees. We talked about the poor performing franchisees, right? And that can happen in any business. Most businesses go through some sort of a revamping, right, of their system. All right. So that's item 20. Let's just go real quickly into the franchise search and due diligence. All right. I talked about this from the beginning. If you can go at it by yourself, or you can go at it working with a consultant like me. If you go at it by yourself, definitely the first most important thing is have a strong why you're doing this. Have a good reason to do it, right? I have executives coming out of Wall Street saying, Sean, I want to get into franchising because I never ran my own business. I want to give it a shot. And that's really not the greatest reason in the world. You want to give it a shot, So we want to make sure, whether you work with us or you don't, that you have a strong why. So there's 2 ways to do it. You can definitely go on your own and research and do everything by yourself. What we see is many of our clients end up starting that way and come to us because it's overwhelming. They can't fit it. There's no discipline and structure to doing it, right? That's what we bring to the table. And a lot of them end up coming to us and asking for our services. But if you're going to do it on your own, at least start with our website. frannet.com. You can look at our directory of franchises out there. They'll show you the name of the franchise, or what type of business they're in, how much money you need to get into that business, what their initial investment is, how much liquid capital you need to have, how much net worth you need to have. At least start there. Now, if you want to work with a consultant, work with someone like myself, we bring you through a 4-step process. Number 1 is education. That's what we're doing today. And education doesn't stop today. We're constantly educating our clients right through all 4 of these steps. The second step, that's where we need to get a lot more personal and intimate with the client. We have to really understand, again, that why, what in their life is going on that they think that they could be successful in business ownership, what's driving them to do it, right? And that assessment it's about a 30, 45-minute assessment. It's kind of a personality profile, but it digs deeper into, do you really want to get into business ownership? What type of industry are you looking at? What type of employee do you want? Do you want 5 employees, 10 employees? Do you want 1 employee? I'm in my business, Franette, I'm 1 employee. So it drills down and really makes you think about what you're getting into. And then once we do that, I just was on a call with client David. We were going through the assessment yesterday, tackling all of these things. And, he really did well. He has a good why, right? He just got laid off. He got laid off 3 times in the last 4 or 5 years. He's sick of it. He's got a good net worth. He's got good financial statements. He wants to build something. He wants more flexibility. He has that good why. So we went through the assessment. Now we're going through the step 3. He wants to move forward. And by the way, you can quit or leave this process at any time. No real questions asked. There's no salesmanship here at all. Step 3 is matchmaking. That's where the rubber meets the road. That's where we really come in and try to match you, not try, we do very well, match you with that right franchise business so that both the franchisor and you, the franchisee, become successful. Typically, we provide our clients with 5 or 6 options, and the ultimate goal is to walk away with 2. And then we go into step 4, which is the coaching our clients through the due diligence. This is where we start talking and introducing you to the franchisor. So it's a 4-step process, this due diligence and coaching step, where step 1, we're going to reach out, we're going to connect you with the franchisor. And there's going to be 2 or 3 meetings. They're going to talk at a high level. It's kind of like an interview in a way. They want to see if you're going to be a good franchisee, and you want to see if that's the type of business you want to be in. All right. And then they'll go through the franchise disclosure document and answer all your questions on that. If everything works out, you go to step 2, which is validating with the franchisees. This is, remember I told you, item 20 is where the list of all the franchisees are. This is where we tell you to go out, talk to 8, 10, 12 of these franchisees to build your business case and your financial model. And if you can meet with them one-on-one, that's even better if they're close, they live close by. If everything works out in step 1 and 2, we go from the due diligence really from the research and due diligence to the decision mode. This is where you're invited to meet in person with the franchisor, and you're going to meet their executive staff all the way down through the people that are going to support you on a day-to-day basis. All right. At the end of step 3, typically you are awarded a franchise. Usually either you bow out or the franchisor says you're not the right fit for us in step 1 and step 2. You get to step 3, you're probably going to be awarded a franchise at the end of that meeting, that in-person meeting. It's usually a 1-day, 2-day meeting at tops. Excuse me. Now, that doesn't mean, because you're awarded a franchise that day, doesn't mean you have to make that decision that day. You don't. This is where you'll come back to us. We'll talk. We'll want to make sure that things are lined up, that everything that you saw in step 2 and step 3 validated, everything that the franchisee said in step 1, and everything is aligning right, and your family is on board with it as well. And then we start to transition into step 4, where we help you with other services. You may need financing. We can help with that. We have financing partners in place. I didn't mention that a few slides back, but we do have finance partners if you don't have one to help you with that. We have accountants, depending on what type of, how do you want to structure your business? S Corp, C Corp, sole proprietorship, I don't know, LLC. We can help with that, with accountants. We have access to many franchise attorneys. I told you, franchising law is real, right? And there are franchise attorneys out there, and we help with that. Again, you don't have to use our services, but we have them available to you, right? And as you're working through these 4 steps, things get, there's highs and lows, with this. Initially, my clients I'm leaving corporate America. I hate corporate America. I'm done with this. They're all excited, all pumped up. They get involved with step 2. They're starting to talk to franchisees, and they're just kind of day in the life. They start to, get a little nervous, and that's healthy. This is where we talk to our clients about getting back to their why. Why are you getting into this? Because one franchisee said this about, it took them 3 months longer to get to break even. doesn't mean you walk away from this maybe. So this is how we help our clients through the consultative process. Maybe you should walk away. That could be another choice, right? So there's emotional highs and lows with this. I went through it twice. Okay, I'm a franchisee twice, and I've been very successful in both situations. And I had a consultant on both of them, and they walked and helped me through this process, me and my wife for that matter. All right, I think we're pretty good, Kylie. I think I think we can go to Q&A.
Absolutely. So we didn't have any questions in the Q&A, but if you're feel free, we are a small
Yeah.
group. If you have any questions to ask directly, we'll take those
Stop
right now.
sharing, I guess, right? I can stop sharing. There we are. I'm back. By the way, I really do apologize for the disruption. I don't know what caused that. I'd like to say user error. Blame me. It's definitely my fault. I don't know what happened. The Wi-Fi got this. I
It's just
apologize
technology.
for that.
Technology is a best friend and a worst enemy sometimes.
Yeah.
It's all good.
But thank you all for listening in. I hope it wasn't too boring. But hopefully you learned something about franchising. And if it's not for you, by the way, you all have networks, and if someone ever has an interest, I'd love to talk with them. But again, I got into this. I'm on the back nine of my career, right? I'm not into this to sell you on anything. I'm here. I did this twice, as I said. I'm here to help people get into this. So I think that's important to say. I do have a passion for it. Hopefully it came out a little bit in the presentation, although I'm not feeling 100%, another thing, but hopefully it came out in the presentation. So any questions, I'm here to answer whatever I can.
I have one.
Sure.
It's actually, my name is Casey.
Yes, Casey.
My question is pertaining to once you're in as a franchisee, if there are some difficulties, like does the franchisor kind of support, give guidance, or does it depend upon the company or your regulatory stuff? Things of that nature.
It can depend on the contract. We really didn't dive into, renewals and things of that nature and getting out of a contract, what you need to do, non-compete agreements and all those types of things that you have. That is a lot of legalese, for sure. But I'll tell you, most clients come to me and they're like, Sean, how can I get out of the business? If it's 3 years, it's not what I thought it was, or something happens, right? Things happen in people's lives, right? And they can't commit to it anymore. And the number one way people do get out of it is through selling that franchise. I mentioned in the systems that we work with, 95% of those resales are sold to another franchisee within the system. And I didn't talk about, how well of a job we do with, bringing in franchise companies into our system and doing the due diligence on them, making sure that they have the support system in place. They're not just focused on them. So they're not just trying to sell franchises. They have the franchisee in mind. We do a great job with that. But that's the number one way to remove yourself from a franchise obligation. But I'll tell you, I have witnessed some good franchisors that do work with their franchisee. If something comes up, that they do not have them have to pay the rest of the franchise agreement and, the fees and things of that nature. They do work with them. It depends on the franchise business. Again, it comes down to those, franchisors that are more mature, very rigid. They're going to be tougher. Not just new franchises, smaller franchises out there are much more flexible and things of that nature. Good question, Casey. That was a very, very good question. Anybody else?
I have a question.
Sure, Sean.
When starting these franchises, are you able, let's say you have a group of investors that want to get into this? Is this something that option is available, or are you limited to just a sole proprietor?
No. I just sold to a partnership. It wasn't a big group of investors, but it was a partnership. It was two gentlemen that knew each other. They go back a long time, and they partnered with a My Salon Suite. It's a business where you get real estate, and they had real estate experience, so it made a lot of sense. You get a fairly sizable unit 25, 30,000 square feet, and you subdivide it and you put in, all type of therapists or salon people, right? People who could haircuts, nail salons, and they get it work. It's a win-win situation because they can get started in 150 square feet for $400, $500 a month versus going out and starting with a couple $1,000s a month. So I just put two partners into that type of business. We do work with some investment groups within our group here in New Jersey that I'm part of. I have not worked with an investor group, but we can make it work because there's some franchise out there, Sean. We have some franchise in our system. Again, they're getting a little bit more mature, and they won't sell to like a one unit person that just wants to buy that one Dunkin' Donuts on the corner. They're not doing that. They're going to want a multi-unit person, either a person or a small partnership or maybe an investor group to come in and buy a whole area, the entire state of New Jersey. I've got, we've got a client down in Texas that's buying, it's a fitness brand, and they're buying almost the entire state of Texas out. So we do work with investor groups. In a long-winded way, we do.
Okay. I have another question, if you don't mind.
Sure, not at all.
So let's say somebody, and this probably varies by organization, but if you have, let's say you have a franchise and you've got this thing built out and you're like, I want to move away from being a franchisee and continue on my own. Is that something that people do? It's probably not,
You mean, so they get into a franchise, they start the business up, they get it profitable, and then they just want to kind of break away and run the business as a independent. Is that kind of what you're
right? Yes.
Yeah, what you would have to do, Sean, unfortunately, you'd probably have to sell the franchise back to another franchisee or the system. By the way, Casey, to your question as well, a lot of times the franchisor buys back the franchise business as well and gets you out of that contract. Excuse me, sort of Propaner, as I told you, they're kind of going through a little restructuring right now. They're not growing their locations. They're still growing their business, but their locations, and they're buying back some of the franchises that aren't doing too well. But no, Sean, you'd have to sell your franchise. You're not going to be able to just break off and be an independent. There's non-compete agreements that go into. So even when you do that,
I would expect so, but I have to ask, right?
No, absolutely. These are good questions. Absolutely. There's no silly questions. I could even get on the WebEx today. So,
right.
So I don't worry about it. That's a great question. Absolutely.
Thank you.
Anyone else?
I think those are some really great questions. And I will also say that we're going to follow up with some follow-up content from Sean, the slide deck as well, a PDF and some information too, as well as his contact information. So if you get off the call, like me, I'll probably get off the call and go, oh, I could have asked that question. You can certainly follow up with him directly and get that feedback directly as well. But on behalf of the Carbon Chamber and Economic Development Corporation, we thank you so much for joining us today. Thank you, Sean, for leading us in such a thoughtful discussion. And we hope you have a wonderful rest of your afternoon.
Thanks, everybody. Have a great day, and I appreciate it.